Uranium is re-emerging as a pivotal lever of energy security and climate strategy, and today it feels overdue. After years of underinvestment, utilities are restocking reactors and planning new builds as carbon targets tighten. Prices have moved, inventories have tightened, and geopolitical frictions at major producers have reset risk premium into spot quotes. Investors watch tightly as Kazakh, Canadian, and Australian mines adjust output, while enrichment and conversion capacity expands unevenly worldwide. The result is a rare combination of tactical urgency and long-term uncertainty, making uranium a focal point for energy, infrastructure, and inflation narratives alike. Traders monitor reactor restarts, policy shifts, and stock draws. Uranium is the fuel that powers most nuclear reactors, turning heat into electricity through fission. It sits in mined ore and in refined forms such as uranium concentrate and UF6, then becomes fuel assemblies used in reactors. The market is not a single price tick, but a chain from mining output to conversion, enrichment, and reactor demand. A handful of producers supply most of the world, and utilities buy under long-term contracts or spot deals. In recent quarters, spot activity has risen as reactors come online or restart after maintenance, while long-term contracts reflect expectations for slower supply growth amid volatile price cycles. Historically, uranium prices spiked during the 2000s, then collapsed after the Fukushima shock and the global slowdown. The industry consolidated around a few miners and a global enrichment supply chain, with storage and long-term contracts stabilizing a volatile market. Since 2018, miners faced capital constraints, permitting delays and public scrutiny over environmental impacts, while utilities faced new safety and reliability standards. The Renaissance began as climate policy unlocked new reactor builds. Small modular reactors promised cost reductions, and geopolitical concerns highlighted energy independence. The COVID era disrupted mine output temporarily, reminding markets that supply can fray when infrastructure ages and demand cycles remain unpredictable. Across exchanges and physical markets, uranium enjoyed a renewed bid after a long bear phase. Utilities sign longer contracts, and investors flock to specialized vehicles tracking uranium exposure. Enrichment capacity expansion promises to lift availability, yet capital costs and permitting bottlenecks temper the pace. Spot liquidity has improved in some periods, but remains thin in others, creating wide bid-ask spreads. The broader commodity complex remains supportive as inflation expectations cool and energy demand resumes, while a handful of producers report higher capex plans. The market narrative now centers on balancing supply discipline with growing power needs worldwide. Investors watch inventories, refinery outages, and policy. Power utilities, mining majors, and traders occupy the center of the uranium story. Utilities sign long-term contracts with Cameco, Kazatomprom, Orano, and Uranium One to secure fuel for reactors from Asia to Europe. Miners face capital intensity, permitting hurdles, and fluctuating capex budgets that influence exploration. Nuclear service firms, enrichment plants, and tailings management companies gain importance in the supply chain. Investors include specialized funds, sovereign wealth groups, and some risk-tolerant equities seeking exposure to clean energy alongside diversified commodities portfolios. The end consumer benefits when power costs stabilize, but marginal cost dynamics can still shift with policy changes across sectors and markets. Geopolitics shapes uranium like few other commodities. Large deposits exist in peaceful regions, but a meaningful share comes from operators in politically sensitive zones, increasing sovereign risk and logistics costs. The energy transition intertwines with national security, prompting investments in domestic fuel cycles, diversified suppliers, and strategic reserves. Global inflation trends, central bank policy, and currency movements influence project economics and debt affordability for new mines. China and India accelerate reactors, Europe debates energy independence from gas, and the United States strengthens enrichment and transportation safeguards. In this macro landscape, uranium pricing reflects a blend of supply risk and climate optimism amid evolving fiscal frameworks. Smart money is calibrating risk and timing, blending thematic clean energy bets with cyclical commodity cycles. Large asset managers and sovereign funds are expanding uranium exposure through specialized trusts, major mining equity positions, and development finance links. Traders watch forward curves, inventory levels, and reactor restarts as catalysts. Some funds emphasize supply discipline and sell-offs when price spikes threaten long-term demand. Others layer diversification by pairing uranium with natural gas, renewables, and copper in diversified energy baskets. Retail access remains evolving, but brokers report growing client interest in uranium as a strategic hedge against policy shifts and inflation. Volatility invites cautious, research-driven participation. Bear case centers on demand disappointment or runaway supply without price relief. If a global nuclear renaissance stalls because of politics, permitting, or cost overruns, uranium demand could stall, leaving inventories elevated and prices under pressure. New mines take years to bring online, and some projects depend on government incentives that may shift with elections. Enrichment capacity remains concentrated, exposing buyers to geopolitical disruption. A stronger shift toward fuel efficiency, non-uranium baseload options, or a surprising drop in reactor restarts could shrink the market more than expected. Finally, money exiting speculative positions could amplify downside quickly. Investors pause, margins compress, and sentiment swings sharply downward. Retail investors can approach uranium with disciplined risk management and education. Start with diversified exposure through broad energy or commodity funds instead of concentrating in a single miner. Set clear stop losses and position sizes that reflect a long-term horizon, not daily noise. Use reputable data on reactor restarts, capacity additions, and policy calendars to time entries. Consider thematic hedges like clean energy or inflation beta to balance energy price shocks. Seek reputable brokers, maintain liquidity, and avoid over-leverage in volatile periods. Finally, treat uranium as a strategic energy component, not a quick flip bet. Stay updated with regulatory changes and market liquidity signals. Looking ahead, uranium could remain volatile, yet increasingly relevant as utilities balance price, reliability, and decarbonization goals. If demand accelerates, new mines and enrichment capacity will try to keep pace, but early projects carry cost and permitting risk. If policy shifts slow investment, prices may drift sideways despite strong energy narratives. In either scenario, the asset class offers a hedge against inflation and a way to express a view on atomic energy's role in electricity generation. For investors, patience, diversification, and diligence will determine whether uranium adds resilience or uncertainty to portfolios. If you found this valuable, Subscribe to the Commodity